When we talk about the legendary figures of Wall Street, the name Peter Lynch stands out for a very good reason. He is celebrated as a highly successful mutual fund manager, philanthropist, and investor. Lynch gained popularity for his remarkable investment prowess in the early 1980s after taking over the Fidelity Magellan mutual fund as a young portfolio manager. When Lynch assumed management in 1977, the fund had $20 million in assets. However, during his tenure, the fund's value remarkably increased from $18 million to $14 billion, with an average annual return of 29%. Quite impressive, wouldn't you agree? Moreover, Lynch achieved this using basic principles almost anyone can grasp. Rather than keeping his strategies a well-guarded secret like the Krabby Patty formula,
the formula for the Krabby Patty!
Lynch generously shares his wisdom with anyone eager to learn through his books. And that's precisely what we'll be discussing in today's video. We'll explore Lynch's investing style and key principles and uncover how they can significantly enhance your investment returns. So without much further ado, let's look at some of the remarkable methods that have made Peter Lynch a true legend in the investment world. Secret number 1. Invest in what you know. In any market, whether it's stocks, futures, options, or cryptocurrencies, people often get enticed by hot tips that promise quick riches. However, Lynch strongly advises investors to only invest in companies they genuinely understand. In other words, as an investor, you should possess in-depth knowledge of the company's background, its products or services, and be able to analyze its financial statements. While certain companies are easy to understand, others can be hard to figure out. But Lynch believes we can use our eyes, ears, and common sense as valuable research tools. He firmly believes that our personal experiences and observations play a crucial role in identifying undervalued companies. When Lynch talks about undervalued companies, he refers to companies whose stock prices are below their actual worth. Lynch views these companies as opportunities for investors because he believes that over time, their prices will increase as the market realizes their actual value, resulting in higher returns for those who invest in them. Unlike many other investors who concentrate on complex financial analyses or market trends, Lynch's approach is much more straightforward, accessible, and perfect for regular people like you and me. So how do we make this technique work? It's simple. Just start by paying attention to the products and services you use daily. If you're a Starbucks coffee lover, consider checking out their stocks. And if you're a fan of Apple gadgets, that might be a sign for you to look into their stocks too. The key is to identify companies you are familiar with, research their fundamentals, and check if they are undervalued. What makes this approach unique is that it's not solely about numbers and charts. It's about truly understanding the businesses and brands that resonate with you. And once you've identified them, Lynch recommends that you... Secret number 2. Conduct a fundamental analysis. Simply put, do your research. Lynch's investment approach is based on the idea of searching for promising companies among a large pool of options. He suggests that the more companies you investigate, the higher your chances of finding good investment opportunities. It's like turning over rocks to find hidden gems. Instead of relying on speculative platforms to provide a list of good stocks, Lynch believes in personally analyzing and choosing stocks one by one. You can follow this method too. Take the time to learn about each company and its industry before investing. When buying a stock, Lynch looked for specific fundamental values. Firstly, he considered the percentage of sales a product or service contributes to the company's overall revenue. A product with a significant share of sales is more likely to positively impact the company's profits. Lynch also used the price-earnings to growth ratio, also known as the PEG ratio, to assess a stock's valuation relative to its earnings growth rate. A lower PEG ratio signifies exceptional value, implying that the market may not fully recognize the company's growth potential. This is precisely how Lynch pinpointed potential investments to include in his portfolio. He looked for companies with solid earnings growth and reasonable valuations. Another factor he considered was the debt-to-equity ratio. He preferred companies with strong cash positions and low debt-to-equity ratios. Such companies tend to have more flexibility and better management of assets in various market conditions. By adopting Lynch's approach and thoroughly evaluating each stock, you enhance the likelihood of making successful investment choices. Nonetheless, you should keep in mind that what worked for Lynch may not guarantee success for everyone. So while emulating his method is an excellent starting point, you need to blend it with your own research and judgment for a winning investment strategy. The other investment tactic is secret number 3: invest for the long term. Lynch believes that successful investors should focus on a company's long-term prospects rather than getting caught up in short-term market fluctuations. Lynch emphasizes that patient investors who hold on to their investments for the long haul tend to benefit from the company's growth and success over time. In his book, One Up on Wall Street, Lynch famously said, "The real key to making money in stocks is not to get scared out of them." He encourages investors to have the patience and conviction to stick with their investments even during market downturns and volatility. Lynch's advice is based on his experience as an investor. He was always well informed about the companies he invested in. If the company's fundamentals, such as its financial health and prospects, were still good, he kept his investments and didn't sell them. This helped him become successful in the stock market. Lynch also didn't try to time the market or predict the direction of the overall economy. Instead, he focused on the company's fundamentals and remained patient for long-term success. Secret number 4: be wary of market timing. So, what is market timing? For those who don't know, market timing refers to the strategy of trying to predict the best moments to buy or sell investments based on short-term changes in the market. Investors who practice market timing usually attempt to predict when the market will rise, that being the best time to buy, or when the market will fall, thus the best time to sell, to maximize their gains and avoid losses. However, market timing is risky because if you get the timing wrong, you might miss out on good opportunities or suffer significant losses. That's why Lynch recommends focusing on long-term investing and holding investments for extended periods rather than trying to predict short-term changes in the market. Lynch even conducted a study on market timing to determine whether it was an effective strategy. In this study, he compared 2 investors. One invested $1,000 each year on the highest day of the year and the other on the lowest day of the year. After 30 years, the first investor earned a 10.6% return, while the second investor earned 11.7%. So even with the worst market timing, the difference in returns was only 1.1% per year. This finding reinforced Lynch's belief that trying to predict short-term changes in the market simply isn't worth the effort. This belief holds true, especially when we look at the global financial market crash in April 2020 caused by the COVID-19 pandemic. Despite expertise and technical analysis, no one could predict or control the outcome because it was an unforeseen event that affected all countries globally. Lynch's principle acknowledges that economies of different countries can be influenced by unpredictable events both within and beyond their borders, and he advises investors not to become overly concerned about these uncontrollable factors. Instead, he suggests directing their attention toward the company they have invested in. If the company has a strong foundation, it is more likely to fare well even in unexpected situations. Secret number 5: look for growth opportunities. Lynch's investment philosophy also centers on the idea that investing in companies with significant growth potential can lead to substantial profits. When it comes to growth stories, Lynch advises investors to determine what inning of the ball game a company is in. The analogy of inning of the ball game is a metaphor often used by investors to describe the stage of growth or development a company is in. In the context of investing, it's comparable to the various innings in a baseball game, where each inning represents a phase or period of the game's progress. In this context, it means that investors should try to assess at which point a company is in its growth trajectory. Are they in the early stages, where there's significant potential for expansion and growth, or are they in the later stages, where growth may be slowing down or stabilizing? By understanding the inning of a company, you can better evaluate its growth prospects and potential for generating returns. Just as different innings can lead to different outcomes, in a baseball game, the growth stage of a company can significantly impact its future performance in the market. One common example Lynch often shares is his successful investment in McDonald's.
People thought there was no room for more McDonald's 5, 10, 15 years ago. They were wrong. If they had done the research, they would have said, well, there's a couple hundred countries out there. There's lots of places to grow.
Lynch invested in McDonald's when other investors believed it had limited growth potential. But as the company expanded internationally in the following 20 years, investors who stayed enjoyed a massive 3,000% return.
Holy smokes.
The lesson here is not to assume that a large and successful business has reached its peak growth. And this leads us to another important principle, which is secret number 6. Understand the importance of diversification. As the portfolio manager of Magellan, Lynch managed a large number of stocks, sometimes as many as 1,400. While he successfully handled this many stocks, he acknowledges the challenges of managing such an extensive portfolio. For individual investors, the number of stocks held will be much smaller, but Lynch still advises against over-diversification. Lynch strongly supports diversification but cautions against going overboard with it. He believes that holding a diversified portfolio of stocks helps to reduce risk. Still, Lynch advises against owning too many stocks as it might diminish the potential for gains. Instead, he suggests focusing on a select few carefully chosen stocks. He proposes that investors should aim for a manageable number of investee companies, such as 15 for instance. If they currently own more than 15 stocks, they should trim their portfolio to reach that manageable number. According to Lynch, diversifying for the sake of diversification is not helpful, especially if it means being less familiar with the companies in the portfolio. Lynch says investors should own as many exciting prospects as they can uncover, but only if they pass all the research tests. He also advises against investing in a single stock. He suggests spreading the investment across different categories of stocks to minimize downside risk. Secret number 7. Learn from your mistakes. Lastly, as an investor, you must realize that you won't always succeed. Losses are a natural part of the investment process. Peter Lynch once said that even if you're good at investing, you'll be right about 6 times out of 10, not 9 times out of 10. So, experiencing losses doesn't mean you're a terrible investor. It's common whether you're investing in individual stocks, managed stock mutual funds, or index funds. Instead of being upset about losses, Lynch advises investors to learn from their mistakes. He adds that by analyzing and understanding why some investments didn't work out, you can make better decisions in the future. Over the years, Peter Lynch's life and investment tactics have had a profound impact on the finance and investment world. He showed us that successful investing isn't just for professionals. Anyone with knowledge and common sense can achieve it. The lessons we can learn from Lynch's life and strategies are invaluable and continue to shape how we invest today. While Lynch's approach is highly regarded, it is essential to understand that it's not a one-size-fits-all solution with magical results. As an investor, you should wholeheartedly embrace your financial goals, risk tolerance, and investment journey. It's not about being the most intelligent or experienced investor, but rather having the right mindset and a thirst for learning and growth.